In almost any other career, if you put in more hours and grind through tasks faster, you make more money. But if you try to apply that same blue-collar instinct to Forex trading, you will destroy your account. This is the trap of the scalper. It's a grueling routine where you're glued to a 1-minute chart, clicking buy and sell constantly, desperate to capture tiny 5 or 10 pip gains before the market reverses. Every time you enter a trade, you pay a hidden toll called the spread. If you're taking dozens of trades a day, these recurring costs slash your profit margins, dragging your net balance into the red even if you're technically winning. Then there's the psychological tax. Staring at hundreds of rapid-fire candles creates an overwhelming fear of missing out. You start jumping at weak signals, and when a rapid loss hits, that stress immediately spirals into revenge trading to try and win it back. You can bypass this burnout by running a strict efficiency audit on your methods and switching to an anti-scalping strategy. Instead of frantic activity, this approach relies heavily on patience. To actually survive the Forex market, you have to let go with the illusion that clicking buttons gives you control. Success here requires a philosophy of calculated, quiet restraint. This chart shows how market noise vanishes when you step back. By moving away from the chaotic 1-minute view and zooming out to the 4-hour or daily charts, you reveal the primary institutional trend. An anti-scalper's entire goal is to ignore the random, meaningless price spikes and instead position themselves to capture massive 50, 100, or even 200 pip movements along that main trend. Let's look at how this works on the New Zealand dollar against the Japanese yen. Price pulls back and hits a major horizontal support level at 91.50. We don't enter the trade yet. We wait for confluence, a strict rule where multiple technical factors must align. Here, a 50-period moving average swoops in to intersect our price exactly at that 91.50 support. With those structural elements in place, we wait for a definitive signal. We get our entry trigger when a small downward candle is completely swallowed by a massive green upward candle. Waiting for this exact alignment on a macro time frame filters out the weak noise. You only risk your capital when institutional momentum mathematically stacks the odds in your favor. Because you're targeting larger structural price waves, your protective safety nets naturally need more breathing room. You'll often be using a wider stop loss, like a 60-pip buffer, to avoid getting knocked out by normal market fluctuations. You compensate for that wider gap by adjusting your position size. You calculate trade volume so that if that 60-pip stop is hit, you never lose more than a strict 1% of your total capital. This chart illustrates the risk-to-reward ratio. Risking 1% for 60 pips requires a target of at least 120 or 180 pips, building a strict 1-to-3 ratio. With this math in place, you can be totally wrong on half of your setups. You take 5 small, controlled 1% losses, but your 5 wins are 3 times the size, leaving you heavily in profit. Protecting your money doesn't come from obsessively trying to win every single trade. It comes from engineering a system where your inevitable losses are completely dwarfed by the scale of your wins. Mastering this approach requires a behavioral reset. You stop staring at every flashing tick on the screen, identify your key zones of interest, set automated price alerts, and simply let the market do the work. Physically walking away from the screen removes the pressure. It strips away the anxiety of missing out and makes it incredibly difficult to sabotage your own trades with emotional reactions. You step out of the role of a day laborer who demands a tiny paycheck for every grueling minute of effort. Instead, you operate like an architect, planning meticulously and executing only when the blueprints align perfectly. Executing this kind of patient, high time frame strategy requires professional-grade clarity and a trading platform that won't eat into your carefully calculated margins. That's why traders use the FXNX One account, leveraging advanced charting tools with ultra-fast execution and 0.0 pip spreads to maximize the efficiency of every setup. In the Forex market, constant action is a liability. True mastery is having the discipline to do